Jeff and I, Jeff and I thought that we might be the only ones in here because I think at one or maybe even 101, I think maybe it was just him and I. So thank you guys for coming. I know that we missed last month. That was partly my moving schedule and partly low attendance for the other classes. So one team decided to pause in July, but I'm super excited to be back, have some really good info. And so I'll probably like kind of just talk off the cuff a little bit for another minute or two. As we all know, agents, including myself, are perennially not thought of as very on time people. So usually we have a decent amount of people coming in here a couple minutes late. So anybody else have any comments about the market before we get started? Anything that you guys kind of want to see out of today? Because obviously data's data, but it can also be presented in a lot of different ways. So I'm happy to talk about the impact of certain things on other things if you guys have anything that's top of mind.
Hey Troy, maybe what's your thoughts on like is 6% where we're gonna maybe
Well, I don't know if God decided that he knew that you weren't supposed to be saying that or not, but you cut off right before you asked the question. And the
oh
only caveat I can say in here is that as an industry, we are still not allowed to discuss compensation. I think most of us are probably from the same brokerage, so technically we could, but I think there could be a couple people on here from other brokerages, and that is the exact collusion that brought this lawsuit into place. So we won't be discussing specific commission numbers. But I'm
no
happy to talk about things in general without mentioning specifics.
no Troy, I don't know if you could hear my question. Could you hear me?
I couldn't. I think, like I said, I made a joke that God cut you off right before you could ask it because I can't answer it. But
Right.
let's ask the question without percentages.
Yeah, I was saying more interest rates. I'm curious to see
Oh,
what interest rate if we
just
get
so
to
happened to be the yeah.
not
Okay.
yeah,
Yeah,
not
I have
interest
I have
rates.
quite a bit in here about interest rates, so I think we'll dive into that, but certainly if you have any remaining questions or conversation, definitely keep it. I definitely should have time at the end. Or in the middle if anything comes up. Don't You guys don't hesitate to interrupt me. This is not like a college lecture. I love um interaction. So Kendra, glad to see you back. I know you've been back for a week or two, but the hero here of the call. So everything's
I
good.
am not back.
No, you're not back. Well,
I
you
am
look
not.
back, so
Well, thanks.
yeah, cool. All right, well, I'm gonna go ahead and get started here with the slides. Like I said, please feel free to interrupt. Um, and let's see. Whoops. I need to get my Zoom right. Sorry, guys. This is what happens when it's been 2 months since I presented. All right, cool. Well, if hopefully everybody's here for the August real estate market update. So if you're not, you can feel free to stay or go. Who am I? I think most of you guys just scrolling through know who I am, but I've been an agent since 2004. I'm also an investor in real estate. So you'll find that some of my conversation definitely skews towards that idea. As you can probably expect if you don't know already, I'm kind of a data driven kind of guy. Definitely, I would consider myself almost a data nerd, maybe. So I really enjoy this. Part of me teaching the class is just holding myself accountable, digging a little deeper, and I really enjoy getting ready for this. So thank you guys for coming. I also do a little bit of one-on-one real estate coaching. You can follow me on Instagram or Facebook there, and we'll go ahead and jump right in. So I would say in general, as per normal, I mean, there's only so many things we can talk about with regards to the real estate market in terms of data. I mean, as I'm sure you guys know, we can go super nerdy and deep, but the reality is, I think for the most part, most of the people come here to kind of get an update on what's going on with rates, what's going on like in the new construction world, the lending world, and then just also kind of talking about year over year, month over month transitions. In my opinion, the biggest value of data is that, you know, there are definitely a lot of opportunities in our industry to sell on emotion, from the perspective of, I think a lot of us get opportunities because of our relationships, right? But when we're sitting in those listing appointments, and now even more than ever buyer appointments, and somebody might be interviewing another agent, how do you show that you deserve to earn the business over somebody else? And I really believe that having good data really makes the conversation way less emotional. And it really just kind of takes the emotion out of the sales. Now, you know, I think Diana Kokoska in Bold is famous for saying, you know, numbers make you think, emotion makes you act. And so it's really just a way, in my opinion, to bring things up that the seller most likely is not aware of. And so it really positions you as an expert, because if your only value proposition is explaining what's going to happen in the course of buying or selling real estate, if you're talking to somebody that's bought and sold 5 houses, and as most of you know, if you talk to somebody who's bought and sold 1 house, they pretty much think they've got that down. But when you talk about data and how data impacts the decisions and the strategy that you're using to sell their home, those are things that somebody that's not in the market every day just doesn't know. And I think most agents aren't going in with a lot of that information. And so just by having it and appearing, hopefully you are, but appearing more prepared than the other agent you're competing against, I think you really put yourself at an advantage. So with that, let's jump into the numbers. So again, for most of you that have been here before, you know that typically I'll go through the national numbers first, which I always say, you know, kind of are meaningless to a large degree from the perspective of talking to a buyer or seller in your specific area. But what it is telling us is what are the trends in the overall market. And although although real estate is local, at the end of the day, the trends usually fall in line with the average and median. So when we look at active listings, some interesting things are happening, and I think you'll kind of see this as we go through the entire presentation here. But you'll see that basically we're starting to trend back towards the pre-pandemic era in real estate. So, and the way that is most obvious is definitely in the active listings, or, you know, some of us call it the inventory numbers. So if we look at all of these lines up here, you'll see the key for what years those are. And basically everything up here is pre-pandemic. Everything down here is, we'll call it the pandemic numbers. And this, interestingly enough, this line right here is 2020. So we had pandemic begin like right about here. And then you can see that it's kind of, it's interesting, but I guess it was going to happen at some point. We've basically crossed over inventory levels for all of 2020 and later this year. And so we're definitely trending, as you can see, back up towards pre-pandemic. The other thing that I would like to point out with this, and this is something that is going to be interesting to watch from the perspective of the fact that over the last 2 years, we've seen interest rates rise in the second half of the year. And now we're positioned in today's market to actually most likely see interest rates start to decline. They already have, but start to decline in the second half of the year. And the other thing we saw this year is that we saw interest rates kind of rising or at their peak during the first half of the year, which again, the last 2 years, that hasn't been the case. And I'm going to ask a quick question. I think my neighbor has a contractor. Can you guys hear that saw? Because I can close the window.
I can't hear anything.
Okay, cool. Well, if you guys hear a saw, interrupt me and I'll close the window. But so yeah, so that's what's going to be interesting. And obviously, as we get into interest rates, we can talk more about that. But we can see that the trend line here. Whoops, whoa, that was really bad. The trend line here is definitely going up. Whereas you can see in like the pre-pandemic era, other than what's this one, 2018, for the most part, we had either plateaued or we were actually trending down by this time of the year. So it'll be interesting to see what August numbers look like. And as we get into the local stuff where we kind of have some right now data, we'll see that so far this month, that trend is continuing. So it remains to be seen kind of what things are going to look like moving forward. So, all right, new listings. New listings are actually still pretty low. And so when we have new listings lower than they have been, and we have inventory higher than it has been, basically what that's telling us is that we're not seeing an increase in inventory because we have a glut of sellers. We're seeing an increase in inventory because we have fewer buyers. And as we go through the information today, what you're going to see is that the number of buyers in the market is really at a level that we haven't seen for quite some time. So pending listing count, this is the interesting number, and I have never seen, and I probably should write this down and do some digging on it, but the pendings number is an interesting number because I feel like it always, especially when we look into the local data, it's always way higher than what ultimately ends up happening, meaning that it's always like higher than previous years, and then it never ends up shaking out in the data. So the only thing that makes sense to me there is that new construction does impact this number. And so when you have a new construction property on the MLS that's sitting and pending for 4 months, that's kind of skewing these numbers a little bit. But ultimately, we are still below most of the pandemic era, as we can call it. Days on market, kind of in line with the inventory numbers, as you would probably expect. We haven't quite crossed over 2020 yet, but I would say we're still like well within the average. Obviously, 2021 and 2022 were crazy low. But when you look at it, it's actually only like 10 to 15 days on market. And so really, I mean, at the end of the day, we're still not in a bad spot. Median list price, and I would say this is what represents that, right? In spite of fewer buyers, in spite of more inventory, we're still seeing prices kind of stay firm. Now, we're not seeing information in the data that's suggesting that we're going to continue to see 5 to 10% appreciation, at least on a national basis. So this is actually telling us that nationally we would expect prices to either be level compared to last year or potentially even a little bit below, because what we know is that as we enter the second half of the year, the median and average prices drop. And that's true, as you can see, pretty much across the board. Again, 2020 was an anomaly year. And that was primarily because for those of you that were in the market, in the industry during that time, you know, the pandemic lockdown stuff happened in March and April and part of May. And so those are typically the 3 busiest months of the year. And so a lot of those sales got pushed to the end of the year. And so, and during the pandemic, even though the lockdowns had ended, we had still had, very, very much a restrictive life compared to normal, you know, no kids sports and things like that. And so that led to people having nothing else to do other than remodel their homes and sell and buy new ones. So that's another thing that happened there. Price reduced numbers. So this was kind of a discussion point for quite some time. The brown line is our price reduced is our 2024 number. We are a little bit above average when it comes to the percentage of properties that are seeing a price reduction. However, what we are definitely seeing is that it's following a similar trend line to past years. So as you can see in 2022, when rates were rising in the spring, we saw the number of properties reducing price go up at a very, very fast pace. As you can see here with the brown line, even though we kind of started the year a little bit higher than what I would consider normal over the last few years, we've really followed a similar trend line in terms of like it hasn't increased at a much higher rate than normal. So again, we're a little bit above average on that over the last 10 years. However, nothing that I'm seeing and that others I've read about are worried that the price reduced share is out of control or suggesting dropping prices. As you guys know who've been here before, I really like this slide, and mostly because we're breaking down both year over year by region, but then also I like the comparison to the pre-pandemic. And so what we see is that obviously active listing count is up everywhere. You can see that the Midwest is kind of right in the middle. The Northeast has had very, very low inventory compared to everyone else. The South and the West have definitely been the leaders, with the South, primarily Florida and Texas actually have been the biggest, if you want to call it, losers when it comes to inventory. They've seen the largest increases. Now, one of the things that is a hypothesis, and I don't have any data on this, but one of the things that happened in the South and the West is during the pandemic, we saw a ton of people move there. And the way that they calculate these numbers is by the actual number of homes on the market. And so one of my theories and hypotheses is that we had so many more people move there. I would be interested to see the percentage of homes on the market that exist. Meaning, if in Florida they built 3 times as many houses during the pandemic as they did in Ohio, does the fact that Florida have more inventory now that they have, way more homes to list, is that really as relevant a statistic as it appears? So, and that's for another day because I don't have the data on that. But the other thing I want to point out is, yeah, inventory is up. However, the interesting thing is that prices really haven't really changed much. If anything, they're still slowly going up. But the average price increase since the pandemic is pretty insane in just basically 5 years or so. So, all right, interest rates, as it's been, really for the last year and a half or 2 years, actually a little over 2 years, is interest rates, they really are the news, right? I think that they drive demand. They certainly have over the last couple of years. And like I said, we're kind of opposite of the last 2 years, where we're seeing the lowest rate levels of the year during this time. If we look back to this time last year, you can see that we were just beginning that huge increase that happened in September, October, November. And so it'll be interesting to see if we continue with either flat or downward trend on rates, what that means for the fall season. Plus, we have a presidential election. So definitely some interesting stuff. So one of the things that I wanted to kind of chat about, and this is a new view, but basically this is what's called a purchase versus refinance index. And the purpose of this is really not what I'm using it for. The dotted line here represents kind of where we are at today. And what I'm paying attention to is this blue line here, and that's basically the purchase index. Essentially, there's some kind of math equation that they use based on the number of applications taken. I don't really know why they can't just count the number of applications taken, but either way, this represents the demand in the mortgage market. And so you can see with the little bit lower rates, we saw a bump in the refinance index. But what we've seen on the purchase side is that although things haven't been dropping substantially over the last, let's call it 12 months, we really haven't seen any kind of bump in the purchase numbers. This dotted line is right over it. We saw a tiny little bump here over the last couple weeks, but nothing significant. So the significance of this is that this is going all the way back to 2015. So 10 years, actually, so mid 2014, we have not seen the number of buyers in the market be this low at all in the last 10 years. And this actually goes back, I think, a couple more years. I think you have to go back to like 2012 or 2013, which was kind of like the tail end of the Great Recession, to see buyer activity at a point that was this low. And so it's definitely something to note that in the Great Recession, the reason prices were dropping is we had way more inventory come onto the market than we had buyers. Right now, we still have very limited inventory, but also we've seen over the last 12 to 18 months, we've seen buyer demand fall off significantly compared to where it was really since the Great Recession. So it'll be interesting to see kind of what happens with this as rates go lower. There have been a lot of people way smarter than me that estimate somewhere between 5.5% and 6% is like the magic number. But I've also heard people say that they highly disagree with that, and they think that people are just locked in, and that is what it is. So this is something that we'll definitely be keeping an eye on. In my opinion, this is what I would call a leading indicator. And so, but this is something that we should be talking to our sellers in particular about, due to the fact that, sorry, I'm home by myself, so when it sounded like my door was opening, so when we saw the when we're speaking with our sellers, we want to be letting them know that, hey, with rising inventory and really low buyer activity, be prepared that we might not have the same showings and all of that stuff, which we'll get to in a second. All right, so what's going on with rates? What's the projection of it? As we've talked about many times, there's kind of two main things that we're looking at. One is employment, or that the Federal Reserve is looking at. One's employment, one's inflation. The Fed is very committed to getting 2% year over year inflation. However, unemployment has been rising, or the number of jobs being created has been falling. And that's forced them to really strongly consider cutting the Fed funds rate. Now, as we've talked about, the Fed funds rate doesn't exactly correlate with mortgage rates. Oftentimes, like the drop in rates that we've seen over the last couple of weeks is actually the market responding to the fact that they believe that the Fed is going to lower rates in the future. So if in September, which is next month, the Fed drops rates by, let's call it, a quarter point, know that drop is, for the most part, already been baked into the mortgage rate a long time ago, because the Fed funds rate deals with short-term lending. The mortgage markets deal with long-term lending, and those tend to adjust as data becomes available, and that's why they're way more volatile than the shorter term rates. So with employment, like I said, the number of jobs created in July was 114,000 compared to what they expected to be 179,000. And so that's caused the Fed to kind of get a little bit nervous about the fact that maybe they kept rates too high for too long. But overall, I would say economic activity, although slower, it appears to be something that is manageable. And that just kind of indicating that they can lower rates. If anything changes on that, we could see rates drop faster. And then inflation numbers came out last week, and those kind of came in line with what they expected. And so again, everything's kind of pointing to the fact that rates are going to come down. Right now, we're at, from a historical perspective, a higher short-term rate or Fed funds rate than what the Fed likes to be at. But because inflation was so high, they felt like they needed to do something a little bit over the top. And now we would expect that this is going to start to be the trend downward to something probably a couple points below where they are right now. A lot of people say that the that the Fed and the government in general like to see mortgage rates somewhere around 5 to 5.5%. So I would say that that's a long-term target, but when we get there and how we get there, there could be a lot of volatility between now and then. So, and again, we talked about numbers. I think a couple great ways right now, and again, these have been tried and true over the last several months, but I think builder incentives are definitely back. One thing I don't have a slide on, however, it happened was last week, the home building numbers came out on Friday, and basically what they said is that builders have really slowed the rate of buying, and they only do that when demand drops. So they've seen a big drop in demand. A couple friends I have in the new home industry have said, actually, I was talking to somebody at the end of July, and they said that they had been pretty consistently selling 4 to 5 houses a month. And I think they wrote their first new build contract on like July 25th. And so that was the difference between June and July. So again, was that a blip in the radar? Was that everybody going on vacation? Who knows? But the builders respond quickly to changes in demand. And obviously they have a lot of model homes with a lot of data in terms of how many people are walking in, how many people are seriously considering an offer, all those things. And whenever you see builders start to ramp up incentives, that should be your first clue that buyer demand is off a little bit. So if you're somebody that maybe only does listings every couple months and you just put a listing on the last time in May, know that your demand right now is probably not going to be the same as it was. But if you have buyers, this can represent a great opportunity to get a lower interest rate and maybe some free incentive, some free upgrades as well. Lender offerings, I know this is not about lending, and so I don't have any specific slides here, but I can tell you guys, the low to moderate income buyer right now has so many options. It's crazy. I mean, I don't think that in my whole career, and it's been since August of 2004, so just past over 20 years this month, that I have ever seen a market where there were so many options that were like mind-blowing. I mean, there are some grant programs that can be tied together in certain areas, like depending on demographics and income and all of that stuff, where you can get like $25,000 or more in free grant money to buy a house. It's crazy. And I mean, if you're buying a $250,000 house, that's 10% and like 0 down, no closing costs. Like it's pretty nuts. So if you want a couple of those lenders, I'm happy to pass along a couple names, but I'm telling you guys, if you're not seeing that number that there are fewer buyers in the market now than normal, if you're not educating yourself on some of these programs, which could be the difference between especially a first-time buyer going to rent again and buying, you're missing out. And for a lot of us, right, like 1, 2, or 3 transactions a year, which you might be able to save with these programs, is the difference between making money and not making money. And so I would encourage you, if you are not talking to some different lenders out there, you're really missing out on an opportunity, and you're also doing your clients a disservice, in my opinion. So definitely educate yourself on lending offerings, and then use these tools like the builder incentives and the lending offerings to get people off the sidelines. When things start to slow down, everybody gets nervous and they think that everything's going to keep going down, and so they wait. And what you need to be able to do, and what I hope to share this information so you can, is to have real reasons to give people why making the investment now makes sense when demand is low, and explaining to them that as soon as everyone thinks that everything's good, it's too late to take advantage of some of these opportunities that are out there. So hopefully you guys are able to leverage some of this data to help you do that. All right, so now we're going to shift gears into Central Ohio. So Obviously, if you're not from Central Ohio, you're welcome to stay on, but that's what the majority of the rest of the presentation is going to be about. So you won't offend me if you leave. But basically, the number of properties for sale is up 39.5% compared from July to July. So that's pretty significant. 10.3% new listings. But you do see this, though, that the number of solds in July was actually 10% more than last July. So the interesting thing here is that at least in July, we basically offset the number of new listings added to the market by having 10% more sales. So the question is, that could be a leading indicator that we're going to see the growth in year over year inventory start to slow down, meaning that as we move into the fall with lower rates, remember last year and the year before with higher rates in the fall, we saw the amount of sales really drop. If we see the amount of sales continue to be higher than they were last year, what I expect to happen is our rate of increase in overall inventory is going to start to lower. So maybe next month it'll only be 35% more or 30% more. So we'll definitely keep an eye on the market. The other thing that I would like to point out that, again, I think you should be talking about in listing appointments is the overall trend of activity, just seasonality in general. We know that March, April, May, and June are like the 3 or 4 busiest months. And then you just really start to see buyer activity trail off. And you can use both the in contract line as well as the new listing line to show that. So this is just breaking out resale versus new construction. Remember, this is on the MLS only. And then this is also looking at like now data. So through the first 13 days of August, we see new listings down 10%. Again, take these numbers with a grain of salt mid-month. If we look at resale, we see new listings last month were only up 8.4% when we take out new construction, but still the solds actually outpaced the new listings. So again, that still goes in line with that. But look at this number. So that's true on the resale, but on new construction, we are seeing locally, at least on the MLS, what they're talking about with the national numbers. We saw the new listings on the MLS go up by 9%, which is in line with the resale numbers. But we saw the number of solds on the MLS go down by almost 20%. So very, very interesting dynamics there. Obviously, what's listed on the MLS isn't really, I don't think, representative necessarily of the whole new construction world, but just a curious number there, or interesting number, I should say. This is just talking about, again, more of the same with regards to those numbers. We see inventory. See what I was talking about that on the last slide, that in July we were up 39% over last year, and now so far in August we're only up 31%. So something to keep an eye on. New listings year to date are still up by 8%. So that means there's 8% more opportunities out there for you to earn a commission check. So that's definitely a good thing. Days on market. The MLS had an issue with calculating days on market for a little bit, and I think this is an anomaly, I believe, and I actually think that these numbers may be a little off as well. So I take this with a grain of salt because I don't think any of us felt days on market double at the beginning of this year, and especially not quadruple. So, but basically we're in line with last year. I mean, we're up 1 day. Original list price or sales price to original list price, though, that is the one. And actually Allison put these slides together and then I go through and update the text, and I forgot to delete this. So this has been updated. But sales price to original list price is down 2%. So last year in July, we were seeing the average property sell for 100% of original sales price. And now in July of this year, we were seeing 2% off. So that's pretty significant because, to be honest with you, 97-98% is pretty in line with historical averages. And so that's a significant change that we'll keep an eye on. Supply continues to still be what we would typically consider a seller's market, even though for some of you, especially if you haven't been in the business for more than a couple years, it doesn't feel like a seller's market right now at all in a lot of cases. But when you look at it from the 30,000 foot view, we're still well off of what could be considered a balanced market of 4 to 6 months. And that's on the resale market. The new construction market, you know, it's a little bit more volatile for a couple reasons. One is because we don't have as much data. And then two is it's very, very seasonal. Just the nature of the market is a little bit more seasonal even than the resale market. So I think we're nearing what could be called more of a balanced market in new construction, but I really do believe their inventory levels, as we see, aren't significantly higher to the point where I think if we saw rates come down to the low 6s, and certainly if we saw a 5 jump in front of it, I think we would see this inventory get eaten up very, very quickly. So that'll be something to watch. This is one I want to spend a couple minutes on at least, and that is the average sales prices. So we've got average sales price down here and average list price up here. Really what I like to look at with this is less about the number and more about the trend. And so what we do see is what I would consider to be a pretty typical seasonal market. Last year we saw an interesting thing where list prices were still going up while sales prices had already started dropping. Here we're seeing more of those numbers stay kind of in line with each other. But one thing that we want to keep an eye on is just the fact that active listing prices are down by 5.8%. That's fairly normal. That things would drop in July. Like I said, it's actually a little abnormal that they rose last year. However, it will definitely be something we want to keep an eye on. If we see, as you can see, August was definitely a much lower number last year. If we see the numbers start to get well below this number, that's when it's something we want to keep an eye on. It might be a leading indicator of some softness with regards to price. But so far, the sold prices have not represented that. So July, we were up still 6% year over year. And the average sold price did go down by 1.3% when comparing June to July. But again, that's normal. And remember, that's the average. And a lot of what drives that are more expensive homes tend to get listed during the spring and summer. You just don't see that many $3-4 million homes coming on the market in November because typically they have the money to carry multiple mortgages. And so they're not going to put themselves in a worse buying position, meaning having access to fewer buyers unless they absolutely have to, which most of them don't have to. So, all right, I'm going to jump into showing data here. And again, we talked about mortgage applications being a pretty significant indicator of demand, but the showing activity is something that I started tracking this year, kind of a few months ago, and it has been really, really interesting to watch, and hopefully you guys feel the same way. So I'm going to spend a little bit of time on it. So this was kind of a hypothesis that I had, and many people have, and that is that interest rates, that demand, meaning the number of total showings is how we're representing demand, would be tied to the changes in interest rates. And what we've seen is that there hasn't been as much of a correlation as what I originally had expected to see. The other problem is that you have seasonality to take into account. But one thing I do want to point out when just comparing overall showings to the past is that we haven't had this few number of buyers in the market since the 5th week of January. So to put it into perspective, this is like wintertime demand right now in terms of the number of overall showings. Now, as you can see, we did see a little bit of a bump up in showing activity after this big drop. So we'll see if that continues. But right now we're seeing very, very low buyer demand compared to the other times of the year. So this is another way of showing rate or displaying showings. This is looking at the last 3 years of showing activity. So we've got the pink line here is 2022, the blue line is 2023, and then the orange line is this year. As you can see, demand has, you know, the holidays are different weeks of the year. Some, or Easter is, and so that represents, for whatever reason, a huge decline. It's probably coincides with Easter and spring break and all those mixed together. But outside of those variations, you can see the orange line has pretty much stayed, other than a couple weeks, below the blue line. And what that means is that there's just been fewer buyers in the market this year compared to last year. Now, the interesting thing is that last week we saw that number bump above last year. And so that's going to be a very important thing to watch. And by the time we meet again next month, we'll definitely have more data on this. But one thing that'll be interesting to see, I think a lot of us hypothesize, right, that lower rates are going to bring more buyers into the market. We've seen it happen at the beginning of 2023. It'll be interesting to see if it happens again here in the fall. We have a lot going on right now. Consumer confidence is low. We have a presidential election. We have a lot of things that can make people very nervous. And oftentimes when people are nervous, they just do nothing. And so it'll be interesting to see, though, if the rates are enough for people to overcome that. But that little bump up is interesting because it really, outside of 1 or 2 weeks, hasn't happened at all this year, since the very beginning of the year when rates were lower. So we'll be keeping an eye on that. I circled this just to show you for now. The next slide we're going to look at, though, is Labor Day. I thought I would share this with you guys. This is real life for me. I had a listing that we had planned on going on Labor Day, on the market Labor Day. And the reason was because of this. Basically, what I noticed, they weren't going to be ready by this coming weekend. And so what I had noticed is there's a small drop on Labor Day, but really it's not significant compared to what happens post Labor Day, especially like it was a little bit in 22, but then last year it was actually lower. And so I'm like, you know what, if it works good for you guys, let's just do Labor Day. So last week I said, Allison, can we just pull some numbers about showing activity 2 weeks before Labor Day and 2 weeks after Labor Day? Let's just see, like, is this graph showing us what we need to? And so basically what I found, so we've got the date for Labor Day. And so instead of looking at the whole week's worth of showings, I wanted to just look at Friday through, I think we did Friday through Monday. And so I don't like the way I worded this, but you guys get the point. So basically 2 weeks before Labor Day in 2021, the showings were 12% more than the weekend of Labor Day. In 2022, they were 23% more. And then last year, they were 8% more. The weekend before Labor Day, they were 20%, 19 and 16. So essentially 15 to 20% more. The weekend after Labor Day, they were 10 to 15% higher than Labor Day weekend. And so ultimately what I did is I took this information and I took it to my seller and I just said, hey, look, I had told you that there wasn't much of a drop off, and probably 10 to 15%. Like if you have 10 showings, that means you're going to get one less showing, right? Not a huge deal. But I just wanted to let you know, I do think that the data supports, unless you feel like you have to list on Labor Day, the data supports pushing it one weekend. If you're going somewhere on Labor Day, you might want to just pass this along and bump the listing to the next weekend. But I thought it was really interesting data. And I thought also that it was just a great way to show you guys how you can use this data to influence the decision of your client based on your opinion of the data. And when you have the data to back it up, it becomes less about a feeling and more about being able to show them. So anyways, I hope that this piece was helpful for you. And then last slide of the day is rental data. Again, being an investor, this stuff is super interesting. One thing I noticed this year, and this all comes from Zillow, by the way, it's a kind of cool data, I think, because they do this for every city. But it's interesting that last year there was a lot of volatility in the rental prices. And this year so far, we saw like a big bump in the early in the year. And then we've been actually pretty level in terms of median rental price. And so it'll be interesting to see if that trend continues. You can see that rent prices year over year are only up 1.6%, which, I mean, again, $25 is $25, but definitely we've seen a cool off of those rental price increases. So if you're working with investors, just something to keep in mind that, hey, don't be expecting that you're going to be able to increase rent, way above where other stuff has been renting recently. So anyways, sources, as always, you guys can email me or just email me at troy@marshhomegroup.com and ask for the slides, and Allison will send those right over to you. But with that, I'll stop sharing and open up for questions. Somebody's got to have a question.
Okay, I'm
Troy,
gonna
I just,
oh,
I'm
stupid
sorry.
monkey. Sorry, whoever was, you can go after me.
It's Todd.
Okay,
No, I was clarifying. My initial question was about when are buyers going to get back in? And the 6% in my mind was kind of maybe 5.99 may trigger that, but you kind of answered that there's probably some varying opinions.
Yeah, I really do think we saw the demand change a lot when things were at like 6.85 versus 7.125. And so I would not be surprised to see putting a 5 in front of that to be a big psychological change. But I also, and I don't usually have it, maybe I'll try to throw it in. I also think a big thing to pay attention to is consumer confidence. People don't like to make big decisions when they feel like things are bad. And then I saw an interesting stat a week or two ago that like 60% of the US believe that we're in a recession, even though we're not. And so whether that's because they're feeling the effects of inflation, whether or not every other commercial on TV is telling them that they should, whatever the reason is, people feel like we are in a bad place. And when people feel uncomfortable, they tend to not do anything. And so I think the question is in an environment where they're very uncomfortable with their finances, what number is going to be too good to pass up? Or what agent is going to be able to paint a picture that making a long-term investment like buying a house, that the variations that could happen over the next 6 to 12 months aren't going to be worth waiting, and know that you can lock in the price and you can always refinance, but you can't go back to now from a pricing perspective. So if you can afford it today, it's only likely to get better in the future. So, all right, Jenny, what do you got?
can you pull the screen up? I don't know if you can get it, that talks about the number of new listings versus inventory being increased. So I just need you to dumb it down for me.
Okay.
Oh, you're basically, is year over year the amount of inventory up because and listings are down, just telling us that we have more days on the market or we have less buyers? Is that what it's telling us?
So new listings are up. However, new listings though, like actually that's not the right one if we want to look at year to date. So new listings are up,
Okay.
but year to date, so they're up 8%, but the number of available homes for sale is up 31%. So the delta, the change between those two is 23%. So that means that even though new listings are only up 8%, we haven't sold as many houses as we've put extra into the market. Now, the problem too is here's the other caveat is that this is a big number because this number was really small. So really, if we're honest with ourselves, all we're talking about is 800 houses. And every year we sell 25 to 35,000 houses.
Right.
So this is a big number because the numbers over the last couple of years have been so small. Does that make sense?
Yes.
Or are you still, it's okay if not, please ask more
How,
questions.
how I look at that. So the good news is we have more inventory, so we have more opportunities for our buyers, but we also have more houses on the market, which means that we have less buyers than we did last year, right? I mean, because we have more inventory still sitting here that hasn't been sold. Is that what it's saying?
Correct, but because the percentage, so the number of new listings is up by what, 1,500.
Gotcha.
And the number of extra houses on the market is only up by 8%, or is only up by 800. So actually, we've sold more houses.
Yeah, that's why when you say that, I'm trying to look like, how do I equate this to meaning to, but I guess the bigger meaning that isn't shown here is when we're talking about buyer confidence being lower, it means I have less competition for my buyer and that I have more opportunities to find houses. Although I still do have several buyers right now that usually it takes me 3 weeks to get somebody in contract. It's taking longer than that because the right houses aren't coming on and they know exactly specifically what they want and it's just not there. And I've
So
tried.
here's actually the best way to describe it, and that's a great question because I can see how it's confusing. Basically, what the numbers say is there are more sellers in the market this year than there are buyers.
Okay.
But because because there are still buyers out there, they are absorbing some of the extra sellers. And so that's why sales are up. The confusing part here is the percentages are so far off.
Gotcha.
That's the confusing part.
Gotcha.
This is probably a better way to look at it instead of looking at active inventory, is
Okay.
to look at the number of properties that have sold versus the how many more listings. So the number of new listings has gone up by 8%, but the number of sales has only gone up by 2.5%.
Okay.
So you have 5.5% more listings that aren't being sold, and that's what's leading to this number being higher.
Yeah.
The difference is that these numbers are a lot bigger than this number.
Okay.
So the percentage change is larger. Percentages can be, you can do a lot of damage using percentages. All the YouTube people, the sensationalists that like talk about how the market's falling, and they use those percentages to try to make it seem like everything's crazy. And then when you look at the actual numbers, it's like, well, that's nothing. And that's what I mentioned briefly too. And Columbus is the same way, right? We might have more inventory, but how many more people have moved to Columbus? So when we were talking about 5 years ago and we had 5,000 houses on the market, well, we had 1.2 million people. Well, now we have 1.25 million people. And we only have 3,000. So actually the number of available buyers, whether they're buying or not, is actually better. And so there's like 1,000 ways to look at data. And so that's a great question. And just know it's not you. Sometimes I have to look 4 times at that stuff too. So
What does that mean?
yeah. All right. What else? Hopefully I didn't just confuse you guys, because I confused myself for a second, as you could probably see. Chris Shea, come on, you're always good for a good question or comment. He does. Oh, there you go.
I'm here. No, that's good info. I kind of noticing that myself, with stuff sitting a little longer. The other thing I've noticed is that my sellers are giving more to the buyers, but we've had a couple more than usual kind of flake out on us too. So I don't know, like just being more weary on really trying to vet the buyers a little better when I'm on the sell side through their agent, whether it's their lending or whatever, because I feel like I don't know what's happening with why that's happening more now than it was to us anyway. I just feel like there's more stuff kind of not a bunch falling out, but more so than there used to be. Just a little more flakiness I feel on the buy side. So I don't know if that ties into, like you said, that unease, with the economy, or somebody kind of gets buyer remorse or what. But I've seen that a little bit. I don't know if you have as well.
Yeah, I think that it's definitely up, I think, across the country from agents that I've talked to. And I mean, obviously everything's a hypothesis because each situation is unique, but I do think some of it is the lack of consumer confidence. And so maybe they go into contract, and then their uncle or their dad or their mom or whatever, calls them and tells them that they're stupid for buying the house or whatever. I think the other thing though, too, that does happen when you have choices is that they go into contract on one, and then all of a sudden the next weekend something lists and it doesn't sell right away. They go have an inspection, the inspection's not perfect. Instead of sucking it up because they had to write 7 offers to get that house, now they're like, oh, well, I actually like the look of that other one on Main Street. And so they're like, I don't really like this inspection report, so let's just cancel this one and go buy that one. I think it's the newfound opportunity of options for buyers that could be also playing into it. And I think it's probably has more to do with the uneasiness though. So that's interesting. We've seen that a couple times too. Or just some listings that have a ton of showings and like no one's pulling the trigger, like that type of thing is definitely happening more, where it's not like there's no demand, but people are just not making decisions basically. So
yeah, and I think they're starting to not feel as pressured, and if we don't get an offer in today, it's not going to be there. They're seeing, no, it's still there. So not every time, but the ones we list that are priced well and still great for the area, they're moving quick. But even in good areas, if they're just kind of a run-of-the-mill good house, they're just taking a little longer for sure.
Yeah, and we even had one where it was like great activity, all the feedback was good, and this person came back and looked at it 3 times, which is, that's how it used to be, right? Back in the day. Yeah, that's what you did every time. And so, but they had the opportunity, they stayed in touch, and they didn't feel pressured to do it, and then they ended up going into contract and they paid, it was a good price, but it was just they wanted to feel good about it, and they felt like they had the opportunity to do that a little bit more than people did, a year or 2 ago. So that's really good. Anybody else have questions, comments? We just rolled over 2 o'clock, so I want to be respectful of your time. No? All right. Well, thank you guys all for coming. Like I said, I think one team will put this on the YouTube channel soon, usually within the next week. And then feel free to email me at troy@marshhomegroup.com if you want the slides, and Allison will get those over to you. You guys have a great week, and I'll talk to you soon.
Thanks, Troy.